Before anything else, I want to start by laying out one simple truth. A bank can be profitable, well capitalized, and appear completely sound. But if it runs out of liquidity, even briefly, it can collapse almost instantly. That's how critical liquidity is. In this first session, we're going to explore what liquidity actually means, why it's so fundamental to the functioning of banks, and how careful management of liquidity can mean the difference between stability and failure. We'll also introduce the key concepts that underpin liquidity practices today and explain why this topic is at the center of every serious risk management conversation in finance. So let's begin by breaking down what liquidity means in banking terms. Now, in its most fundamental sense, liquidity is about a bank's ability to meet its financial obligations as they fall due, without suffering losses that are unacceptable or unsustainable. So those obligations can include anything from paying out customer withdrawals to meeting loan disbursement commitments, settling debts to other financial institutions, or fulfilling clearinghouse requirements. In essence, liquidity is about cash, or assets that can be very quickly turned into cash. It's not about whether the bank is profitable or whether it's got a strong capital position. It's about whether it can pay its bills today, tomorrow, and in the near future, even under stress. You see, banks operate in a unique business model where they transform maturities. In other words, they take in short-term deposits, so funds that customers can pull out any day, such as the cash they have in their current accounts, and banks use those funds to lend long-term, like issuing 5-year loans or 25-year mortgages. Now, that gap between the short-term liabilities and long-term assets creates what we call a maturity mismatch. Now, this mismatch is profitable to a bank because banks earn a spread between the cost of short-term funding and the yield on long-term loans. But it also creates a vulnerability. If those short-term liabilities are suddenly withdrawn or can't be refinanced, the bank has to scramble to find cash. This is where liquidity risk arises. Liquidity risk is essentially the risk that a bank won't be able to meet its obligations when they're due because it doesn't have enough cash or can't convert assets into cash quickly enough without heavy losses. And when liquidity risk materializes, it happens fast. Now, unlike credit risk, which plays out over months or years, or market risk, which can vary daily, liquidity risk can cripple a bank in a matter of hours. Now, this immediacy is what makes it so dangerous and so central to how banks are regulated and run. So let's take a moment to illustrate this. Now, imagine a hypothetical bank. We'll call it Industry Bank. Now, Industry Bank has a large book of residential mortgages, which generate steady income over the next 15 to 20 years because customers continue to pay off their mortgages and their respective interest payments. Now, most of its funding comes from retail and corporate deposits. For years, Industry Bank has been profitable. It passes all of its regulatory capital requirements. Now, from a balance sheet perspective, it looks healthy. But now imagine a sudden rumour spreads, maybe online, maybe through financial press, that Industry Bank is facing trouble with one of its loan portfolios. Within a day or two, a significant portion of its depositors start to withdraw their funds just to be safe. After all, there's nothing stopping them from doing so. Now, if Industry Bank doesn't have enough liquid assets on hand or quick access to borrowing, it may find itself unable to meet those withdrawal requests. It may need to start selling off assets quickly at poor prices. Now, confidence erodes further. More withdrawals follow. A self-reinforcing cycle begins. And within days, Industry Bank faces a full-blown liquidity crisis. Now, this kind of scenario isn't just theoretical. We've seen it in real life many times. In fact, history is full of examples where solvent banks, meaning they had more assets than liabilities, failed simply because they didn't have enough liquidity to survive a short-term shock. Northern Rock in the UK, for instance, failed in 2007 because of a severe liquidity issue, even though its long-term asset base was strong. More recently, Silicon Valley Bank in the United States experienced a devastating run that unfolded in less than 48 hours as corporate clients rapidly withdrew deposits amid concerns about interest rate exposure and asset valuations. The bank could not meet the outflows and collapsed. Now, these events serve as a stark reminder that liquidity is a real-time issue. It's not about what the balance sheet says in the long run. It's about whether the bank can meet its cash needs right now. So what does this mean for liquidity management? It means that banks need to actively plan for liquidity demands across multiple time horizons. They need to be able to meet daily settlement obligations and customer withdrawals, but also survive a prolonged stress event where funding dries up, where markets become dislocated and confidence evaporates. Now, this involves having access to high-quality liquid assets. Assets like government bonds or central bank reserves that can be quickly sold or pledged without taking large losses. It also involves being able to predict how cash will flow in and out of the bank under different conditions. Now, one of the most important concepts in liquidity risk management is the idea of the liquidity buffer. The liquidity buffer, or liquid asset buffer, whatever you prefer, is a stockpile of unencumbered, high-quality liquid assets that the bank can draw on in times of stress. So think of it like a reserve of emergency cash. Regulators around the world now require banks to maintain a minimum level of such assets under rules like the liquidity coverage ratio, which we'll discuss in depth in a future session. But beyond regulation, banks themselves have developed internal liquidity risk frameworks, which includes models and limits that govern how they manage their daily and long-term liquidity positions. So let's now briefly touch on how banks actually go about managing liquidity. The central function involved is the Treasury department. Now, Treasury teams oversee daily cash positions, ensure funding sources are diversified, and execute liquidity plans. They work hand in hand with risk management functions, which conduct liquidity stress testing, scenario analysis, and contingency planning. Now, together, these teams are responsible for identifying liquidity gaps and ensuring that the bank has access to cash at all times. Now, banks also make use of what's known as funds transfer pricing, or FTP for short. Now, this is an internal pricing system that attributes a cost to liquidity. If one part of the bank wants to use funding, for example, to issue a loan, it will pay a notional liquidity cost to Treasury. Now, this internal pricing encourages business lines to think carefully about their use of funding and ensures the true economic cost of liquidity is built into decision making. Now, at the same time, liquidity risk is heavily influenced by external market dynamics. Banks rely on capital markets to raise funding, whether through issuing bonds, accessing repo markets, or borrowing from other banks. If markets freeze or counterparties lose confidence, those sources can disappear. That's why liquidity management also involves careful monitoring of market signals, bid-ask spreads, haircuts, counterparty behavior, and overall investor sentiment. Now, in addition to managing their own internal liquidity, banks must comply with a growing body of regulatory requirements. These include quantitative rules such as the liquidity coverage ratio and the net stable funding ratio, as well as qualitative frameworks like the Internal Liquidity Adequacy Assessment Process, or ILAP for short, which applies in the UK and EU. Now, these frameworks require banks to show that they understand their liquidity profile, have appropriate governance in place, and can respond effectively to stress scenarios. Now, we'll be diving into each of these regulations in future sessions. So why has liquidity management become so central to modern banking? The answer lies in the lessons of the past. Time and time again, financial crises have shown that liquidity failures are contagious. When one bank fails to meet obligations, counterparties get nervous, withdrawals increase, market funding dries up, the failure spreads. That's why regulators and central banks place such a strong emphasis on liquidity buffers, funding diversity, and its ability to withstand shocks. It's also why banks invest in technology, analytics, and modeling capabilities to forecast cash flows with increasing precision. But liquidity management isn't just about defensive measures. It's also about enabling growth. A bank that has robust liquidity controls can take advantage of opportunities. It can lend more, invest more, and move quickly without constantly worrying about survival. So in that sense, liquidity management is not just a risk discipline, it's a strategic one. When managed well, it becomes a source of strength, not just a safeguard. And for all of those cost-conscious finance professionals, let's not forget that liquidity also has a cost. Holding high-quality liquid assets often means holding assets with low yields. Funding long-term projects with stable sources may be more expensive than using short-term funding. Now, that trade-off between safety and profitability is a central tension in banking. Liquidity costs must be balanced with business needs. Part of good liquidity management is understanding that cost and pricing it appropriately. It's not about eliminating risk, but about managing it intelligently. Throughout this course, we'll explore all of these themes in depth. We'll look at how different banks approach liquidity management, how regulators assess liquidity, and how stress testing and contingency planning work in practice. We'll examine how emerging risks like digital disruption, climate change, and geopolitical shifts are reshaping liquidity dynamics. And we'll end with a forward-looking view on how technology, particularly artificial intelligence and the rise of central bank digital currencies, may impact liquidity frameworks in the years ahead. For now though, the key takeaway from this session is that liquidity is not optional. It's not just another line item on a risk report. It is essential. A bank can survive credit losses. It can survive market swings, but it cannot survive a liquidity freeze. That's why liquidity management sits at the heart of everything a modern bank does. In our next session, we'll take a closer look at how liquidity management has evolved over time. We'll trace its history through past crises, from the early bank runs of the 19th century to the global financial crisis of 2008, and the more recent turmoil in 2023. Now, this historical lens will help us understand why today's rules and frameworks exist, and how the past continues to shape the future of liquidity management. I'll see you in the next session.